Welcome, everybody, to our Straddles and Strangles webcast. I'm happy you joined me here today. I'm happy to be here. I'm Connie Hill. We meet each week at this time and talk about a couple of strategies that we might employ when we don't know what the potential outcome might be of something. To our Straddles and Strangles strategies. Say that twice or 6 times really fast. I am joined in the chat by Cameron May. I'm happy Cameron's here. He'll help me answer some questions that might come up that I can't quite get to, but I am going to keep my eye on the chat, see what your questions are. Now, I'm hoping that you're starting to follow along with some of these example trades that we're doing, because that's really how you'll learn so much better is by doing, right? Versus just kind of watching. So if you are and you have done something like that, followed along, and you have a question, let me know. I'm seeing a couple of those come in right now, which I'm glad to see. Hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS. We'll post educational content, things that we notice out in the marketplace that we think are interesting or noteworthy. We will post about them. So take advantage of that. There's not a lot of ways that you can communicate with us, but X is one of those channels, as is commenting on the classes and asking questions there. Let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. What we talked about today is intended for educational and information. Don't consider it a recommendation. With long options, investors may lose 100% of funds invested. We'll be using the Paper Money software application. It's what you download to your computer. It's the most robust version of Thinkorswim. Looks a little bit different than the web version and the mobile version. One difference in Paper Money is that options will not be assigned early. In a live account, they can and will be assigned early, but your paper environment doesn't mimic that, okay? Investing involves risk, including the loss of principal. Now, there was one comment in here, last phase of life says, hey, could we talk about legging out? Yeah, we'll actually probably do that a little bit. And if you have a more specific question about it, let me know. Last one is past performance is no guarantee of future results. Well, let's go ahead, just see what's going on in the market right now. Then we're going to follow up on a couple of our trades from last week. And if you've been doing those trades, practice trades in your own account, and you have questions, let me know as we're going through those discussions. So let's head over to our Thinkorswim and let's just take a quick look. Looks like the markets are they're having a pretty decent bounce, at least right now. That's our SPX. Nice big candle today so far, at least. So up 0.37%. Let's try the NDX. Looks like it is up 0.63%, so a little bit stronger. You can see here I had drawn, let's make this like a 6-month chart. You can see that I had this big old triangle in here that the NDX was trading in. And it was interesting when it had this breakout right here, just last week. It broke through that diagonal resistance. It broke through that horizontal resistance. So we were looking at, well, maybe this will be a strong breakout, but it didn't really stay there, did it? It fell right back into the triangle. So it'll be interesting to see now if it breaks beyond the resistance diagonal and horizontal, if it finds some strength there. We'll keep an eye on it. Volatility index, what do you suppose it is? If our main markets are up, where do you suppose it is? Yeah, you would suppose it's down, right? So nice big drop here, back to what is it, 16.84. So getting back down into a little bit lower range of the VIX. Not super low yet, but not as high as it was 1920 last week. So we're feeling that, the put call ratio that measures is letting us know that put buying is not so rampant as it was. And so that comparison of put buying to call buying is starting to favor those of the long calls versus the long puts. Okay. All right. Let's take a look at our first trade that we did last week. This one is now. And I've kind of diagrammed it on here what happened as far as our our involvement. We don't need quite that much time access here. Let's just kind of go back to, say, like 20. That'll show us a month worth, and we can see. So now, ServiceNow was going to announce last week, and so classes on Monday. So we got into the trade on Monday, this date, but they didn't really announce until here. And so you can see, I think that was a Wednesday, the 28th. It was a Wednesday. I haven't changed my calendar yet, so I can see the January calendar. And then dropping. Okay. Now we did, last week we were just kind of doing vanilla straddles and strangles. Both of these being, well, I can't remember. I think they're both straddles. We had been doing some straddle strangle swaps. And so I says, can we just do kind of some basic ones? So these were just pretty basic, okay? But did we get a big move on this one? Yeah. And when we're buying those two long options, a call and a put, whether they're the same strike or different strikes, same strike is a straddle. Different strikes are what we call a strangle, and usually those are out of the money. Then we can see, yeah, it made a big move. So we look at the numbers here. Let's go over, well, I should say, and then we got out after that big drop, we got out that day. You can see there's a little bit of a shadow down here. And so it went kind of low, but as the day wore on a little bit and it started creeping back up there, we decided let's take the money and run. Okay. So if we come over here to our account statement, when we got in on the 26th, actually, let me look, is that the 30th? Yeah, the 26th, we paid $8 for this. When we got out, what we did is we just let our call expire worthless because it was so far out of the money. They weren't going to give us anything for it. But we did that on that Wednesday. I guess it may have been, actually, we went a little further than that. Let me look here. I marked this out on the 29th, and actually it was the next day on the 30th, but so that shorter candle. So it looked like, hey, it's probably not going to fall much further. Let's go ahead and take the profits, get out. In any case, all right, so $8. What we got in for, we sold that long put for $14.30. That gave us a net of, what would that be? $6.30. The gain on that, we just did one contract, so $630 on that opportunity. Now, sometimes they will pay off really big for you, and sometimes they might not, okay? Sometimes you have to make decisions really quickly, and sometimes you have a little bit of time. So like in this case, it dropped, it started to rally up, but it was kind of staying down here into the area where it gapped down to, which is why we gave it another day just to see, but then it just didn't really produce anything, so we got out. All right. So somebody wanted to know about legging out. And I'd say maybe that is an example sort of that. We didn't close down the whole trade because they wouldn't buy our callback, really. They weren't going to give us anything for it, so you just let it expire worthless. And then you just focus on the leg that you want to get out of. Okay, hopefully that makes sense to you. Now, Starbucks was a real volatile puppy here. Let's pull it up. So same thing, we got in on Monday, and they didn't announce for a little bit. Can you guess which day they announced on? This ginormous candle. So they had their earnings, and they usually do this. They did theirs before the market opened on the 28th, so that was Wednesday again. From the day before, it looks like it did what? It gapped down a little bit. And then it ran. Look how high it ran. It went up, put in a brand new high, 104.82. How do we manage this one? Because it ran up and then it ran way down. Now, theoretically, if we had veins of ice and we saw this thing run up here, and logically you might go, man, that put's not going to work. Let's get out of there. But if you had veins of ice, or maybe you forgot the company was announcing that day, and you look at it a day or two later, you actually maybe could have made money on that put side with the continued drop. But what we did is when it started racing up here and was looking really quite positive, we're like, okay, we'll get rid of our put. We legged out of that side of the trade. And then as it ran up, it was looking good, but then the profit started to dwindle. And so this one, and this happens sometimes in these trades, you're making a judgment call that you don't know if you're making the right call. Now when it had the big gap, that was maybe a little bit more, gee, it has that big gap to fill, so maybe it can't reverse so quickly. Sometimes in situations like these where the stock just runs up and then you see it start to fade, if you're watching it and you're noticing and you see kind of this tall shadow, the top side of that candle, that's giving you a sign that it's fatiguing. And as it pulls back and pulls back, yeah, it's really starting to fatigue quite a bit. Now, I think I misspoke here when I said, where did Starbucks open? I said they opened down here. That's actually where they closed. Initially, they gapped up here, then ran up, then started to fade. Okay. So we didn't make money on this one, unfortunately. Like I said, if we had veins of steel, maybe it would have worked out better. So here's our Starbucks. We paid $7.25 for that. That's straddle, right? 97, same strike price here. Let's go look at our timestamps about when we got out. Okay. So this first time stamp is at 7:53. Now you need to know I'm in the Mountain Time Zone. Okay. So for me, the market opened at 7:30, and I have my Thinkorswim platform set to my local time. Okay, so we, after about 23 minutes after the market opened, and it looked like that was running up there, what did we do? We sold that put. We were like, man, we better get something out of it because that thing is just racing. But then as it ran and it started to pull back, that call started losing money big time. And so at 9:08, which was an hour and 38 minutes after the market had been open, when that thing started to fade, then we said, we just need to salvage what we can. Okay. And so we got out at 285. So this one ended up being a little bit of a loser for us. So 725, I was starting to do the math here. Let me grab a calculator. Let's do the math. 725, let me go to my keyboard here, minus 93 minus 2.85. So we lost about 347 on that trade. So we made over 600 on the first trade, lost 347 on the second trade. Now, iShares says, that's the story of my life. Well, hopefully things are not always flipping around so much. In an ideal world, it would do something like what Now did. But we can't control it, and we don't know, right? The market, we all find out together. So I think it's important for us to walk through the process, discuss it, so you have an idea, okay, why did we decide to do this on that trade? Why did we decide to do that on the trade, right? Now, Chris says, on such trades, is there a good way to see exit targets? Or to set exit targets? Absolutely. And that might have been a better way to do it. Maybe we could have come in here and said, all right, if we get, say, like if it goes to the call side and we get certain return on better than $3.40, say maybe we set it at, say, double that, 680. I'm just throwing a number out there. Okay. You get 680 or whatever. Yeah, maybe then you do want to get out and then you have a stop on the other side if it gets, say, half the price of what the option was. So you could go in and you could set one cancels other orders on it if you wanted to. And you could do it on both legs, right? Both the call and the put. And so sometimes that is something that can work in your favor. Now on, say, the Now, let's go back to Now. On Now, when we saw this big drop in here, I mean, that is really quite large there. I wouldn't have faulted anybody if they said, hey, once it gets to that, it drops and it starts going down, I'm getting out. Couldn't fault anybody for that, because look at that distance on there. And we maybe would have been more profitable had we got out that very first day. Well, actually, we did. Maybe a little earlier in the day, right? But we never know. We never know. Practice says, what about an example of a credit straddle? We're going to do that today. We are going to do that. What are my thoughts on the Analyze Earnings tab? What are my thoughts on the Analyze Earnings tab? That's a story for another day. Yeah. We won't go into that simply because there's some other stuff I want to cover, but I'll keep that last phase. I'll put that as a question for us to maybe address next week. That be all right? Okay. Let me see if there's any other questions that I missed that I need to answer. Cameron can't answer for me. I think we're in pretty good shape here. Okay. Today, sometimes you look at some of these strategies and you're like, some of them are clear, man, it's better if you're a seller, it's better if you're a buyer, but we really don't know what it is. Today, we're going to look at, let's start out with our first trade here that we're going to look at, PLTR. And so first thing we want to know about it is, does it move a lot over earnings? We can see with this market maker move that what is priced into the at-the-money options is about 9%. That's a pretty decent sized move if we expect it to go up or down 9% or more. And you can see with that little script I have there, it shows how far out that is. So you're looking at that, you're going, yeah, it's a pretty big move if that is what's expected. There might be some of you that do not have yet that script for the market maker move, so I'm going to share it with you. And it should be, where did it go? Usually I just kind of have it sitting out here so I can share it with you. There it is. I'm being a little bit blind right there. I call it the market maker move on the chart, the MMM on the chart. So those of you that are familiar with scripts and would like to use that script, those of you that are listening to this on the recording only, I'll put it here in the text box so you can see it. Might need to pause so that you can grab that address. And then what you're going to do is you're just going to you can take the entire URL or just the part that starts with the exclamation point like I'm going to do. And you just set up, open shared item, plop it in, you preview. If you don't like what I named it, name it something that you like. MMM chart marks, that makes sense to my brain. I'm not going to import it, but you would. I don't want to import it again. You only want to bring in scripts once because you have them. If you bring them in a second time, a third time, a fourth time, it kind of junks up your accounts. You're like, oh, I've got multiples of these. You don't really need them. Okay, so the market maker move, I'm going to come over here to PLTR, is what the market makers have priced into the move for the event. Now, in this case, the event is earnings. The event could be something else. It could be, say, if it's on a biotech stock, it could be the date when the FDA has said they will give some news out about that company's their I don't want to call it a drug, but their prescription, their drug, whatever it is they're trying to get approved. Sometimes they know what that date is going to be in advance, and so people might posture over it. And so if we say, well, how much do we think it's going to move? That's what this is right up here. And that's what we call our market maker move. And it's kind of small, so I'm going to make a little drawing on it if I can get my drawing tool to cooperate here. Let's try this. Some days it works, some days it doesn't work so good. So it's this little guy right here. Now, this little icon here to me looks like barbells, free weights, It isn't. It's an MM on the top and an M on the bottom for market maker move. And this is what implied volatility is priced into those options. Now, they're going to announce tonight. And so we look over here and we say, well, how much implied volatility is priced into those options? 119%. That's a lot. Okay. That is like, wow. And then you look at the next week out, it drops down to 85% and then starts getting into the 70s and the 60s, right? Where it's kind of, I'm going to say it's normal area, but 119 up there is enormous. Okay. So in this instance, we might go, well, why don't we sell the options instead of buy the options? Okay. So we're going to look at that. What if we were to take advantage of that selling option strategy? Let me clean this up a little bit here. Let's go with the straddle. The straddle gives us more premium than a strangle would. Okay, because we look at the at the money here, it looks like it's 150 is what we're going to have our at the money here. And so if we sell the put side at 720, we sell the call side at 780, that's a chunk of change. So let's go ahead and we're going to queue that up. I don't want that. We hit the number, not the letter. So, all right, we're going to sell both 150 call, 150 put. And that brings in about $15 of premium, which is $1,500 per contract. Now, it is a little bit more of an expensive stock, but the big thing here is the implied volatility is just super, super high. Now, I'm going to just hit confirm and send here for a minute because I want to show you on this. Shows us what our break even would be, 134.88 or 165.12. That's a pretty big swath through there. And then for whatever reason, mine does not calculate commissions in there, but just know you're going to have a commission charge on there. And then the buying power effect here down about $3,000. So that's one way to approach it. But what thing might a trader consider if they have on a naked call? A naked put, not necessarily quite as scary, but a naked, oh, I didn't mean to delete that. I just wanted to close it. But a naked call, if the stock, for example, goes up and you've sold the call there and it goes past your, if it goes way, way up, you've got to go buy it back in the open market so that you can give that stock to somebody else if you get called out on it. So theoretically, it has unlimited risk. Now, it's not likely that PLTR is going to go from 150 to, 250, but, theoretically, it could do that or higher or lower, right? And so because of that, we might want to put on something to hedge, something to help protect us a little bit, okay? So what we're going to do here, we're going to close the 6. We're going to open up the next week, February 13th expiration. You can see there's a huge drop in implied volatility there. And what we're going to do is we're going to buy we're going to do an out of the money strangle. And this is called a straddle strangle swap. Okay. So our rules here, yeah, we can look at that risk profile. Maybe we would look at the risk profile before we put on our hedge. Let's do that. Then we'll look at our hedge. So let's say, let's go analyze trade to our risk profile. Let me kind of get this. We don't need the iron condor in there. We'll get rid of that. And then I'm going to make sure here that we're just hiding positions so that we don't have any positions showing here. All right. So this is kind of what this risk profile looks like. So teal colored line is options expiration date, what the max theoretical gain and loss of options expiration. We want to make sure up here in the upper right-hand corner, we have the date. So the Saturday after the expiration or the date after the expiration, okay? And the peak profitability is right there right at the 150 strike price. That's where we would get that theoretical max gain. But you can see the theoretical max loss. It'll just continue the slope downward. If I were to kind of scrunch it like this, you can see that loss could be really substantial, that you're like, that is not worth $1,500 to have potential risk at what is this there? Oh, $8,700. And if we go to that side, we're at $10,000, right? So you're like, I don't feel maybe very comfortable with that risk, which is why we would want to put on those hedge legs. Okay, so we're going to head back. We're going to put on hedge legs and this is going to be a strangle. We're going to go out of the money. We're going to look for a delta of 20. So let me put my 40 back on here, because we want to look for a delta of 20. So it's going to be quite a ways out of the money. And on the put side, we're going to do the 135. It's going to cost us 273. And on the call side, let's go find a 20-ish delta, whatever we can find the closest. Looks like 19 delta will be the closest. So we're going to go ahead and we're going to buy this call, which is going to be a 172.50. Okay. Now that takes our credit down from the initial $1,500 down to, say, about $1,000. Oh, but we can breathe easier, right? We don't have that unlimited risk. So let's go ahead. Let's analyze this trade. And I'm just going to get rid of our first one there. And you look at this, you're like, oh, I can breathe a little bit easier here, right? $500 loss on this side. And then it would taper down here on this side, but we're not looking at those huge numbers like we were if it was untethered. Okay, so that's why we consider putting on, buying the call, buying the put next week out, where implied volatility isn't as high. And then quite a ways out of the money, I would say a 20 delta, so that we can try to conserve what we have there. Now, on this one, let's go ahead and put in a value to get out of the trade and just close the whole trade down if we get a certain value. Okay, so the question would be, what value might that be? Because the implied volatility should come crushing out immediately, right? Out of those front week ones that we have sold, right? Our 150s here. Man, that should come crushing out just as soon as the announcement is out. Okay, so what number are you comfortable with if we put it in? Hey, what if we got 30% of that? Would that be nice? Would you hold out for 50%? It's kind of maybe not realistic to think we're going to get all of it. Okay, so if you have an idea there, then I'm happy to entertain whatever your percentage might be. Let me look here what your questions are. Let's see here. So, Stegel says short put vertical might be a better option for PLTR. Well, if we were in a short put vertical credits class, we might argue that. Okay, but since we're not, really what they call this, that straddle strangle swap, when you do it here, it's called a double diagonal, because technically we are using different time periods of expiration, different strike prices. Okay, so which turns it into a diagonal, and we've got a call side and a put side, so it's a double diagonal. Now, one thing that could be interesting if you wanted to try this, stay gold, is you could say, well, let me do what I might do with a short put vertical. Was it a short put vertical you were thinking? Yeah, short put vertical. You go ahead and do it, and then if you want to compare it, you could go ahead and compare it, right? You're in your paper money account. That's where you want to learn. Okay, that's a fantastic place to learn. What is the impact or effect of the different expirations? The impact of buying these a little bit further out is that they're not so expensive. They're not as expensive as if we had bought the same strikes here in the February 6 options, because they have more implied volatility priced into them. That means they are more expensive. Okay, so appreciate you asking that. Any concerns, says Mary Burns, any concern if this beats expectation that you have a short squeeze on? You guys know what a short squeeze is, if the stock's being shorted, and there's possible news that comes out. So in this case, it's going to be earnings. And because it, say the stock is heavily shorted, people are betting against it, so to speak, and it pops up, then those shorts, those people who are short, have to cover. They've got to run and cover to cover their short status by shorting the stock. And so it can create a big spike in the stock at times. Now, I don't know what the short interest is on this one. Okay, quite honestly, did not even consider that. On a short squeeze here, you're saying, man, this thing has been bearish, or maybe it is highly shorted. I don't know. Really, the bigger thing is what they're going to say with their earnings, right? We're expecting a 9% move one way or the other. We don't know what direction. So could some of the short covering, if it were to have short covering, be part of that? Yeah, it certainly could be. But there's nothing. We're just taking a stand. We're saying we don't know which way it's going to go, so we're going to play both directions. All right. Now I do want to do another trade with you here. Hopefully I covered the questions. If not, send them in. Cameron's been helping me out there answering your questions. There are some other companies that are announcing this week. Let's do AMD. Now, AMD, a little bit more expensive of a stock, but the expected move isn't quite as big. Okay, what's priced in here? 6.66%. Now, many times what I'll do, and we do this in our class frequently, we did a lot last week, we go back and see, does this company make big moves with earnings announcements? Because if they really don't, might not want to use either of these strategies. Might not want to do a straddle or a strangle, or go short a straddle strangle on them. Okay, so if it's down here, this market maker moves at 2%, 3%, then it's kind of like, they're not really expecting that big of a move. Now this move, 6.66, is not as big of an expected move as we had with Palantir, but I'm going to say it's still a healthy expected move. Okay, and again, this is just coming over from the trade page, taking that market maker move and determining, how much implied volatility is priced in there, and therefore impute whatever the move is expected to be, but not guaranteed to be. Now I didn't send this little guy in, so let's go ahead and send him in. Looks like about right now, using those midpoint prices, about 10.29. And I'm going to put this in our straddles and strangles. So AMD, we're really going to do this similar thing. We're going to sell at the money. It has 97% implied volatility priced into those options that expire this week when they announce their earnings. And then the next week back here, look at that, it's 22% lower. Okay, so not nearly as expensive as if we said, well, maybe why not do the strangle in the same month or the same weekly expiration? I said month, but that expiration. These are going to cost significantly less. All right, so let's go through this again. It's trading at 247.42, and they have a nice little strike price, 247.50. That's going to be our at the money strike price. So again, we are going to sell the straddle. So we're going to sell, and I should tell you, I'm holding my control key down as I click on the bid price of each of these. So for not being such a big move, because the options are a little in the pricey range, it's about a $20 credit. But again, we have the same problem, unlimited risk on the call if it goes way up. And, 247 all the way to 0 is not obviously likely, but theoretically it is possible, right? So you have to account for that. So again, we're just going to buy some out of the money strangle as our hedge. All right, so again, we're going to go for the 20 delta. So the closest one here is 21, so that's fine. We'll go 21. I want you to notice the stocks we're working with have lots of options available. And the spreads on them have been pretty tight, so like 10 cents here. We want to see that. We want to see lots of liquidity. We want these to be easy to get in and out of. If there's a strike price, for example, that you, like say, for example, say you decided to do the 18 delta instead of the 21 delta, but you saw there wasn't as much open interest here, 46 contracts, you know, it might be okay, but you'd probably feel a little bit more comfortable knowing there's a lot more trading activity with something that has 1,000 contracts, okay? So that's one thing to look for. All right, looks like we got filled on that trade. All right, we're gonna buy the 225 put, and we're gonna do the same thing here. We're gonna go out to a 20-something delta, whatever's pretty close. And we're going to go with this 19 delta over 1,000 contracts here. And then we're going to buy this call option. Now, something does not look right here. And the thing that doesn't look right is this one right here. This one should be a positive. There we go. All right. I must have clicked on the bid price instead of the ask price here, okay? So definitely we want this to be a call and a put positive, and on our straddle, call and a put on the short side of things. So that dropped our credit down to 13. Protection costs, hedges cost, but that's still a pretty healthy gain. Now, what we were going to do, and I forgot to do it on our first trade, is to put in a first triggers. Let's just do a first triggers sequential here and say if we get X percent here, let's go ahead and close it up. Okay, so we're going to go ahead. We're going to say create opposite order. What if we get here? Okay, we're at 1305. What if we can get 35% of that? That would be $456. For a pretty short turnaround trade. They announce, I think it's tomorrow night they announce. Okay. For example purposes, we're just going to go with that. We're going to say, fine, buy it back. We're going to do it at I think that was 465, right? Just double check it. 456. That's some of the numbers, right? All right, 456 as a debit. Actually, do you know what? That's not the right thing. This is how much we would get out if we get profit of this, okay? 4.56. So really we need to take the difference in the 1307 credit. And if we get the 456, what would that leave us with? That's the number we need to put in here when we come and buy it back, okay? So bring back the calculator. 4.56, we're going to take the difference between that and 13.05. All right, so then we're saying, okay, we would be content to get out at 848. We're going to make it good till canceled. And this, we're just going to leave as a day order here. And let's see. So Coco says, so we're managing the gains by putting in this first trigger sequential order. How do we manage the loss, please? If you wanted, you could do an OCO and say, get out if it gets, say this credit gets to, I don't know, something you're uncomfortable with. Say the credit gets to $18. I'm just throwing a number out there. Going $5 the opposite direction, you could do something like that. But many times, what will happen is that it's going to make one move one direction or the other. And then typically we try to get out of the loser and then carry on with the winner, whichever side it happens to be. Okay. And so you'd be wanting to watch it. When earnings come out, you want to be watching, see what's going to happen to it. Let's see what Harry's saying here. Just checking. Certainly similar to a butterfly. Okay. Yeah. Cameron's helping you out with some answers there. Okay. John wants to know on NVIDIA for a straddle or strangle. We actually did NVIDIA. Well, maybe it was the last earnings cycle we did NVIDIA. It'll be coming up. Okay. We're going to go ahead. We'll just do it with, hey, if we get a chunk of the profit, we're out. Go buy it back. We'll be happy with that 456 for a trade that doesn't last very long. All right, we're going to go ahead. We're going to put this in our straddles and strangles bucket. And what are we going to be paying attention to? We're going to pay attention to Palantir's earnings tonight. And AMD is tomorrow after the market closes. Okay, so we'll have a couple to be watching, one in the morning and one the next morning on Wednesday morning. Okay, and we'll see what they do. If they make a real clean move, it might make our decision easy. So we'll see. We'll see what happens. So we've got one with a target profit, one without. All right. Now, I hope you guys are subscribers of our YouTube channel so you can find our content easily. We make it so easy when we do that. Let me just show you real quick here. Get my right. Maybe I don't. Well, let me just say that. Makes it so much easier to find our content. I usually have a window open. I don't have a window open. So just know that's the case. If you really want to get to know these strategies, do tons of paper trading with them. Okay. That's how you build up a comfort level. That's how you decide maybe you do want rules. Maybe you do want to put in exits for every single trade rather than trying to figure it out in the heat of the moment. Right? That's when you learn that. Okay. So some of you have been trading along with it, with these trades, and some of you haven't been. So it's going to encourage you. Paper money, right? It's not going to hurt you. You want to definitely practice in your paper accounts. All right. If this is helpful to you today, go ahead, hit the like button out on your way out. Follow Cameron and I on X, Cameron May CS, Connie Hill CS, and then subscribe to our Trader Talks channel so you can find our content. All right, you guys. Coming up next is going to be Barb Armstrong with Trading a Smaller Account. So take a little bit of a break, and we'll be right back at the top of the hour. We'll see you then, and we'll check up on how these trades played out next week.